Good afternoon, everybody. Uneducated Economist here. So I would like to thank Jack. Jack is one of our viewers. He sent me a $20 super thanks yesterday, and he asked a couple of questions and then asked me if I could do a video that covers some of these questions that he was asking. Now, I have just recently done a video covering a speech given by Christopher Waller. It's called What's the Rush? I'll leave a link down in the description of it. But I think this speech is pretty good at answering some of the questions that I believe Mr. Jack had. Now, the first question that he had was talking about the Federal Reserve. They will not lower rates or waste their ammo because nothing has broken yet. Now, this is a very interesting question to think about because a lot of times when we think about the Federal Reserve and them keeping interest rates elevated for a significant amount of time is that they are going to cause a recession by doing this. But the Federal Reserve looks at it much differently in that they probably are not going to lower interest rates unless there is a significant reason to lower interest rates. Now, I'm going to read from this speech because, again, I think this kind of covers a lot of that question. It says, commentators often argue that by delaying rate cuts for a meeting or two, we run the risk of leaving or of having over-tight policy that can cause a recession in the near term. So this is what a lot of people are thinking about, including, I believe, like in the question here from Mr. Jack, is that they're not going to do this unless there's actually some sort of issue, right? While I find this narrative to be interesting, I also find it somewhat puzzling. The reason is as follows. When rates are going up, most of the discussion is on the long and variable lags of monetary policy, with rate hikes not having a serious impact on the economy for 18 months or more. So even by the time the Federal Reserve adjusts interest rates, it would be 18 months down the road before that has any kind of serious impact on the economy. Okay? The reason is as follows. When rates are going up, most of the discussion is on the long and variable lags of monetary policy, with rate hikes not having a serious impact on the economy for 18 months or more. But when it comes to delaying rate cuts for a short period of time, we supposedly risk suddenly driving the economy into a recession. So this is what a lot of people think out there, is that by keeping the interest rates elevated, the Fed is going to force us into a recession. And this is what he's kind of reiterating from that narrative, right? The supposed asymmetry in the lagged effects of rate hikes versus rate cuts is puzzling and not supported by any economic model that I am aware of, right? So what he is saying is that when interest rates are moving up, everybody talks about how long it's going to take before that impact starts, or before that interest rate adjustment moving up, how long it'll take before that actually has a serious impact on the economy. Now, everybody knows that there's a lag period in between that. But yet everybody seems to believe that when the Federal Reserve lowers interest rates, it has some sort of instantaneous impact on the economy. And he is saying there's no economic model that will defend that kind of argument, right? Let me read it again. But when it comes to delaying rate cuts for a short period of time, we supposedly risk suddenly driving the economy into recession. This supposed asymmetry in the lagged effects of rate hikes versus rate cuts is puzzling and not supported by any economic model I am aware of. So they don't know anywhere in their economic models that by delaying rate cuts would force a recession. Right? How do we square this circle of this narrative? I think the explanation is that, as I noted earlier, rate cuts tend to occur after major economic shocks that cause or threaten to cause a recession. Think about that. As I have noted earlier, rate cuts tend to occur after economic shocks that cause or threaten to cause a recession. This is when the Federal Reserve typically lowers interest rates, economic shocks. Historically, large and rapid rate cuts are highly correlated with recessions, and this leads to the inference that policy was too tight and actually caused the recession. So people look at that and they said because the Federal Reserve quickly adjusted interest rates, it must have been the high interest rates that caused the recession. The Federal Reserve is saying, no, if there wasn't an economic shock, we wouldn't have dropped the interest rates so rapidly to deal with that economic shock. So the recession and them battling it, people believe because they moved interest rates down so quickly, it must have been the high interest rates that caused the recession. And he is saying historically, large and rapid rate cuts are highly correlated with recessions and leads to the inference that policy was too tight and actually caused the recession. Right? What they're saying is that it was an economic shock. What people are trying to say is that it was them keeping interest rates too high. But it is very difficult to untangle the effects of tight monetary policy from major economic shocks when looking at past recessions. If they lower interest rates quickly, only the people who are taking out new loans at the time get to take advantage of that. People who had already had previous loans at the higher interest rates now have to spend their time refinancing those into the new lower rates. That's the untangling that he's talking about. That's, it takes time to work that in. All right. But it is very difficult to untangle the effects of tight monetary policy from major economic shocks when looking at past recessions. We do not have the counterfactual of what impact delayed rate cuts would have had on the economy in the absence of a rate shock or of an economic shock. Right? So that's very important to think about. We do not have the counterfactual of what impact delayed rate cuts would have had on the economy had they not had the economic shock. They don't have any economic model that shows that. Right? That basically saying that, because they lowered interest rates so rapidly, it was due to the economic shock. There is no economic model out there that says, hey, because you failed to lower interest rates, it actually caused this recession. Right? Because they typically would not lower interest rates unless there's an economic shock. You see what's happening here? So like them keeping interest rates elevated in their mind, or at least from their economic models, right, is saying that keeping interest rates elevated is not the reason why there was a recession or the reason that would cause them to have to lower interest rates. Economic shocks that were unforeseen would be that reason. You see where I'm kind of getting at here? This is very confusing, I know, but this is what they are saying. We have to follow what they are saying because they're the ones who are in charge of monetary policy. My conjecture is that in the absence of major economic shocks, delaying rate cuts by a few months should not have a substantial impact on the real economy in the near term. And I think I have shown that acting too soon could squander our progress in inflation and risk considerable harm to the economy, right? That's them giving up their ammo. So this part right here, I think this little section of the speech is very telling and very clear in responding to that particular question. They'll not lower rates or waste their ammo because nothing has broken yet. Exactly right. The Federal Reserve would typically not lower interest rates unless there is some sort of issue taking place within the economy. He goes on to say, are you saying the Fed is basically waiting for a recession to happen and then they will lower rates? What I'm saying is that it's going to take an economic shock for the Federal Reserve to typically lower interest rates. All right. And then I thought we were sensitive to rate hikes. We are. Believe me, the issues that are coming quickly. Now, I'm going to set this all aside for just a second and talk about some things that are occurring out there. So when we think about the Federal Reserve and the raising of interest rates and the impact that will have on the economy and the lag time, right? So when the Federal Reserve goes to raise interest rates, it will be somewhere around 18 months down the road before it has a serious impact on the economy. Think about this for just a second. How long ago did the Federal Reserve begin to raise interest rates? All right. It's coming about that time now. These rising of interest rates are now starting to impact the economy in a serious fashion. Now, think about this for another second. John Williams, Federal Reserve President of New York, very, very influential when it comes to the FOMC, the Federal Open Market Committee. These are the 12 members who vote on monetary policy. John Williams recently came out in the mainstream media, the corporate media, talking about how the Federal Reserve will probably not be lowering interest rates until sometime in June. Right? In June. Think about 18 months before that particular time and where the Federal Reserve was moving their interest rates to. That's the impact that it's going to have at that time, right? Got to look back 18 months. Here's another interesting thing. The Treasury Department has said that they have planned bond buybacks sometime in the middle of 2024. Right? What is this all leading up to? Liquidity issues. John Williams knows it. The Treasury knows it. Right? Everybody is now getting prepared for a downturn in the economy. I mean, like, seriously getting prepared. The Federal Reserve has got the banks, sitting in a position in which that they have their balance sheets adjusted to deal with a higher a stressful impact, like a stress test. These are the things that are taking place within the economy right now. It leads me to believe that the idea of a liquidity crisis is still coming sometime in the middle of 2024, this summer, somewhere around June. Now, I'm not trying to predict that. What I'm trying to say is John Williams, Fed president of New York, super influential, talking about lowering interest rates sometime in June, would only make sense that there would be an economic shock for them to do that, right? Wouldn't a liquidity crisis be an economic shock? Treasury plans on buying back bonds during that exact same time, right? And we have to think about what it is that the Fed funds rate was doing 18 months before that. They were rising significantly. And it takes 18 months before that lifting of or rising of interest rates will have the full impact on the economy, what we're expecting here in the next few months. All right. I'm going to leave it at that. Uneducated Economist. Thank you, Jack, for that $20 super thanks. That is very cool of you to support the channel. Uneducated Economist. You guys let me know.